Lovely.
I think we're recording. All right. Hi, everyone. Thank you for coming tonight to our Investing 101 session 5. It's the last one of the semester. And it's going to be led by Henry as usual on do-it-yourself versus professional money management. I hope you enjoy. Thank you for tuning in. And yeah, Henry, feel free to get going whenever you want.
Wonderful. Yeah, good evening, guys. Great to see you here, and cheers for the introduction, David. This will run as usual. Any questions you guys have, I'm going to stop every few slides. David's monitoring the chat as always, so we can get an interactive discussion going. The content discussed tonight, I think, is particularly important and relevant to a lot of the society. And I'd like to make that clear at least after the session, so that people that missed it can go up and watch on YouTube. But yeah, for all of you that are here live, I think this is a very useful and very practical session that most people will benefit from. Right, so without further ado, yeah, so warm welcome. Okay, so what's on today? So the main point that I was going to touch on is how we as individual investors have advantages over the institutions. This is a very, very, very important point, because a lot of people, what goes through a lot of people's heads is it's just like, what do I know? Like, I'm a young little student. How am I going to compete against the big boys, right? And people have that mentality. And I had that mentality for a long time. And it wasn't until I really comprehended some of the things I'm going to talk about in today's session that I realized it wasn't a complete waste of time for me to actually go and do a lot of this stuff myself. Oh, we're up to 10, David. Lovely. Yeah, so in addition to that, we're going to analyze some of the wider asset classes, such as mutual funds and ETFs. And we're also going to explore if kind of doing the do it for yourself, let's invest in X, Y, Z approach isn't for you. We'll look at some alternatives and kind of have some discussions on that. The disclaimer, again, this presentation is solely for educational purposes only and in no way constitutes as financial advice or an investment recommendation. All information presented is factual and correct to the best of the author's ability. That's me. Neither Henry Gardner-Roberts nor UOB Investment Society take any responsibility for anyone's investment decisions. And when investing, the value of your investment may go down as well as up. Okay, so this is the question that we had. How could we as individual investors have some advantages over institutions? When I say advantages, I'm not saying that we have complete advantage, and that we can beat the institutions in every way possible. Obviously, these big boys that you see on the right-hand side of your screen are going to have a huge amount of advantages as well. Whether it's a net advantage or not, that's a very difficult thing to weigh up. But there are many, many advantages that we do have. And if we capitalize on them and make the most of them, then we can get superior returns. We're up to 12. Lovely. Right. Okay, so Joel Greenblatt. Has anyone heard of Joel Greenblatt before?
I haven't.
No, he is a very successful hedge fund manager. I believe his firm was called Gotham Capital, and he was renowned, I think, in the bull market period in the 90s for returning 40-45% a year annually. It was absolutely nutty, but he was one of the few people that has made those kind of returns consistently. And he broke his investment strategy down, or the basics of it, in another book called The Little Book That Beats the Market. It was also by Joel Greenblatt. He broke the investment strategy down in that book. And also You Can Be a Stock Market Genius. But this book, not quite as well known, The Big Secret for the Small Investor, he as an institutional investor, talks about how individual investors like ourselves do have some advantages. It's often the first book I recommend to people. And if you remember, back when we did the first session, somebody asked me about book recommendations, and I coincidentally, sheer coincidence, had that book on my table. And I said, go have a look at this, purely because it sets up the motivation, right? Like there's no, people aren't going to have like motivation to work out complicated financial theory and do all the research and build all this if they're not convinced that it's worth their time. And they won't be convinced it's worth their time if they don't think that they have any chance of beating a fund or beating the institutions. And that's what he was trying to demonstrate in his book. And I have a lot of respect for somebody like that who, as an institution or an institutional investor, as a hedge fund manager, be kind of humble enough and unbiased enough to recognize that individuals like us do have advantages over the institutions. Okay, yeah, so I talked about this a little bit in the first slide. So disclaimer, whilst I'm about to tell you some of the advantages that I think we have, that obviously institutions have a lot of advantages. A lot of you are probably applying for these kind of roles at the moment, and they're very, very competitive. The reason is they want the best of the best. It's one of the most complicated, most brutal, very difficult work industries to kind of work in the world. And obviously they want very highly intelligent and capable graduates to go and fill those positions. Obviously, as you get more and more authority in these places, you have more and more experience, and that also leads to good decisions. So that's one disadvantage we've got. They've also got superior technology. Things like Bloomberg and just access to data. A lot of you guys probably now know about the Bloomberg terminal in the library since it's been publicized on our WhatsApp group chat. But yeah, superior technology has become a lot less, but it's still an advantage that these institutional investors maintain. Number three, ability to invest in products often not available to the general public. That's particularly prominent with things like private equity, and also extra exposure with company management. So for example, when a company is doing an earnings call, if you're a VP or an MD in equity research, you can just go on and you can ask a question. I worked at a mutual fund once, and they owned 5% of Halfords, the kind of auto repair bike manufacturer and kind of servicer in the UK. And that meant that they had significant controlling interests, and they would have a very close relationship with management just because they owned so much of the actual company, that it meant they took a very, very direct play. But even if you're a big institutional investor who is owning a fraction of a percent, it's still in management's best interest to maintain a good relationship to you, because they could move the share price quite significantly, or if one broker swings from a buy to a sell, it could catalyze the brokers going the other way. And then that would mean the share price would fall and then less bonus for management. So yeah, I mean, there's a lot of reasons why they would get extra exposure and connections. I thought I'd just go through the type of institutional investors real quick. What have we got on here? Venture capital, that's when a business is in kind of its seed, somebody has an idea. It's very much think Dragon's Den, for example, or kind of The Apprentice. I know some of them have a bit more established businesses, but it's when people have an initial seed idea and they need an injection of cash to kind of really take it off. Venture capitalists, it's a high risk, high reward game. Like most VC firms, they will make all of their money from a couple of investments over their lifetime. They'll make loads and loads of investments in small companies, and most of them will fail. But if just a couple of them do 100x on the investment, then the venture capitalist is worth their time. So hedge funds, so hedge funds and mutual funds are both kind of portfolio managers who kind of manage a selection of investments on behalf of us, right? A diversified group. The difference between them is mutual funds are a bit more legally constrained. Hedge funds can do some more sexy stuff. They can basically borrow shares they don't have on the market. And they can so if they think a share is going to go down, they can borrow shares they don't have, pay a price for that, and then buy them back at a cheaper price. That's what you call short selling. They can trade on margin, so they can take they can take a position that's double the weighting for the same price effectively. That's kind of the main difference between them. Private equity is similar to the VCs, but a little bit further on. It's where a company's not open to the general public, but they're looking for private investors to give them cash in exchange for equity. Endowment funds, they're more funds set up for charitable means, like high net worth individuals wanting to give back to a charity project, that cash has to be managed by the charity. The university probably has a massive endowment fund from alumni that have done well, etc. And the way that they differ is they often have very specific goals. So for example, charity funds would be very ESG. Because for example, if cancer research had an endowment fund and it had British American tobacco in it, and smoking tobacco has been shown to cause the majority of lung cancer cases, that'd be very hypocritical, and they would lose a lot of their donors very quickly. So insurance companies as well, again, like the way insurance companies work is obviously they make some of their revenue organically, where the amount of premiums people pay outweigh the amount of payoffs that they have to kind of fill out, in terms of successful claims that come through. But in the process, obviously insurance companies are sitting on a boatload of money. They need to invest that somewhere. So they're an institutional investor. And also pension funds, like, again, it's same thing as a general fund, but with a specific goal in mind, i.e. a pension fund would be giving people very consistent income because they might be dependent on their money for retirement. Right, any questions on that, David?
Yeah, we got one in the chat from George, which is, you're referring to borrowing shares for hedge funds. You're saying, is this borrowing what swaps are?
Oh, that's a complicated question. Not quite. No, swaps. Yeah, okay. You're testing me now. Swaps are a very complicated type of deal where it's mutually beneficial for parties to like swap debt. That is a very complicated thing that I don't know the intricacies of. What I'm talking about where they're borrowing shares, it's called short selling. So basically what will happen is, a hedge fund will just like, they'll speak to a broker or they'll just do it electronically. And they're effectively able to, it's like a loan, but it's a loan for shares. And what will happen is that they temporarily borrow them. They pay a fee for doing that. It's more expensive to short sell than it is to long. And then what will happen is that the share price goes down. They're able to buy shares back at a cheaper price. The reason that mutual funds would be more regulated against it is that short selling is more risky. The reason it would be more risky is if you're a fund and you long the share and the share went bankrupt, well, the most you can lose is 100% of your money. You're very rarely going to lose that because there'll usually be some sort of liquidation of all the assets and you might get something back as a shareholder. When it's short selling, the downside is limitless. So say, for example, you bought shares at 8 or you sold shares at 8 that you didn't have. If the share price went up to 40, you not only have lost 100%, you've lost 500%. And you have to cover that extra 400%. David, do you have anything to add on swaps? It's not something I know much about, but I know it's like where it's like mutually beneficial to like swap debt.
To be honest, what you've said is more or less the extent of my knowledge on swaps. I'm sorry, I can't give you any more. But yeah, I definitely is something that we should look into. Maybe to talk about in the future.
All right, thanks then. Thank you.
Sorry about
that. I hope that clears everything up short selling wise. Those are the kind of main institutional investors, and obviously these institutional investors, they employ vast swathes of kind of analysts who help them make investment decisions. Who have we got in the chat? Is Amrit here yet? No. Oh well.
No.
Okay, right, here we go. So this is the kind of meat of the presentation. Advantages for the individual. I'm sure a couple of you have read Simon Ree, but one of the reasons almost comes directly from his book because he explained it very well. Right, so these institutions, they're not incentivized to help us. And when I say us, I mean small investors with relatively small amounts of money grow wealth quickly. The incentive for them is that they get paid on a fixed percentage fee. You'll hear about kind of, what's the annual charge on the fund? Is it 1%? Is it 1.5%? This is how they make their money. So what that means for them is richer clients make more money. So make them more money. So they are incentivized to attract rich clients. What do rich clients want? You know, people that are very rich, they're much more focused on wealth preservation, very stable. Can I take an income from this investment? You know, can I use my investment to live off? Can I retire? They're not so concerned with, oh, I need to grow this at 20% a year for the sake of it. We're very loss averse people. Imagine if, you know, you had 10 million, you know, you wouldn't be so concerned about bam, 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 growing it at 20% a year. You'd be more concerned with, I want to preserve this wealth. I want to grow it slowly. I want to grow it steadily. Can I take a regular income from this wealth to, you know, to subsidize, or maybe I don't even have to work in the future. So that's how it works. Anyway, so what Simon Rees said, going back to the fees, quoting directly from his book, the key objective of Wall Street and most financial firms are to convince wealthy people that have money to invest to let the firm look after their money, charge a fee, and not get sued in the process. The investment industry as a whole does not pay its employees more if their clients generate higher investment returns. Wall Street simply doesn't have the resources or the inclination to help individual investors grow their wealth rapidly. Yeah, I took that directly from the book because I couldn't have put it better myself. If I swing you guys back up here, I'll be able to see what's at the bottom. Yeah, so again, I've got a flow chart for this, just to explain it again. Step one, as I said, Wall Street makes money from a fixed charge on an investment. Is the fee 1%? Is it 1.5%? Obviously, the incentive structure is to attract a client with 10 million rather than 10,000. You know, why would they want someone like us to manage? You know, why would they be bothered if we were coming in with 10,000, their fee was 1%, and we'd only be paying them £100? It wouldn't really be worth it. Like, they could, you know, because the marginal cost of them doing that isn't very high, but it's much easier to scoop in the people with 10 million and take a 100 grand fee.
Henry, do you mind if I jump in very quickly?
Yeah, of course, mate. Carry on.
Sure. Just for anyone that I guess needs a bit of context, Simon Ree was the first guest speaker that we had this year back in August, basically before term even started. And he's literally, as Henry's put it there, he's a financial markets professional and he's a legend. He's a great guy. And his book that we're referring to is The Tao of Trading. You can get it on Amazon for like £7 or something, and it is a really, really great book for beginners. Definitely, we're going to run a session actually later on in the year on kind of the key points of the book and key ideas, because it is such a useful, insightful book. Henry, I'm sure you'll agree. So definitely go check that out. If you want, I can send you the link for the book on Amazon, but I'll just put the name in there now. Sorry, Henry.
No problem. That's a good point. I've never had the technicals explained to me so simply as in that book. It was a very, very, yeah, you know, no, what's a non-swearing word for no bullshit? Like no frills, just to the point, you know, that kind of thing. I should stress here as well that Simon Ree wasn't just a kind of go it alone, stumbled into investing kind of guy. So, you know, it's very easy to say all this stuff, and it's very easy for me to say it, having only had a couple of internships and not really done my time years and years on Wall Street. But, you know, Simon Ree spent 25 plus years in a multitude of different sectors in finance, you know, in multiple big names. And he is very, very qualified to make statements like this, you know, with 25 years experience in some of the top companies in the world. Right, where was I with this flowchart? Yeah, so I pretty much made the point, but rich clients' needs are to focus on wealth preservation and safe, stable returns. They don't want the rapid wealth accumulation. You know, it's not worth the risk for them. You know, if you go and read, I'll tell you about something quite interesting. If you go and read about behavioral economics, right? And say, for example, we've got two scenarios, and somebody said to you, you've got a 50% chance of winning £2,000, or a 50% chance and a 50% chance of losing nothing, or you can go 100% and win £1,000, right? Those are your two kind of options. Most people would flip the coin and go and try and win the £2,000, right? If you flip that experiment over and say, right, this time it's about loss. You've got a 100% chance of losing £1,000. You can cash in your grand now and pay it up to us, or 50% chance of losing £2,000, or a 0% or a 50% chance of losing zero, right? In that second scenario, people would rather pay the £1,000. Sorry, no, what am I talking about? Let me just get this clear.
Yeah, I was going to say I'm not going to lie. I prefer the 50% chance, mate.
50% chance of losing nothing. Yeah, sorry, I've got this the wrong way around. So I've got it. Sorry, right. Forget what I was saying. In the first scenario, most people would take the $1,000 for certain, right? This is my point. It's about loss aversion. In the first scenario, when you've got a 50% chance of winning the $2,000, 50% of losing nothing, or guaranteed $1,000 right now, guaranteed, most people would take the grand. If you flip that over, David's right. Most people, they don't want to lose money. They would rather 50% lose nothing and maybe lose $2,000 as opposed to guaranteed losing $1,000. But the point is that like for these people with a lot of money, they're not so concerned about growing 20 million into 22 million really quickly. They are much more concerned about preserving the wealth, taking in income from it. And that's what Wall Street is incentivized to do. And therefore they chart that. Therefore, that is reflected in their investment strategy to help attract more rich clients. Wall Street is not incentivized to generate superior returns, which take increased effort and then often increased risk, because they're not really being compensated for doing it. But they do run the risk of losing their rich clients if they do run these high risk strategies, and then the investment backfires. You know, it will only take a 1 year loss of 20% to scare anybody rich away. You know, like if we go in with 10 grand and we go down to 8 grand, yeah, that's pretty scary. But if you go in with 20 million and you're losing 20% and you're down to 16 million, you know, we're talking a huge amount here. So this is where the incentive comes in. And what I'm trying to say is the incentive is not set up for funds to be boom, high risk, let's grow your wealth as quickly as possible. They're incentivized to attract the rich that want wealth preservation and stable income. Do we have any questions, David?
I don't think so. No questions. No questions. You're good.
Second advantage for the individual. Right. This is a very, 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 very big one for me. We're under no constraints from either higher management or the actual investors that the funds constantly have to please. The disadvantage with this is that when you're your own boss, or like when you're like looking over your own investments, there's not many people looking over your shoulder. It's been improved a lot because we've got the internet and ultra connectivity, and you can kind of talk on online forums and watch YouTube and shit. But you know, it's not like you're in a massive team all kind of trying to focus together. But that's also a massive advantage. Most people that get other people to manage their money for them, their investment psychology isn't particularly strong. And you can see what kind of happens in the flow chart here. What I'm trying to say is that the market cycle of people's emotions, it often leads for them to kind of buy high and sell low. You know, most investors will see market, up, and they will go, boom, I want to go invest in this fund. And if you look at, in fact, I wish I had the data up, but if you look at the kind of percentages of Americans that invested in mutual funds, or they did a large scale survey, and they said, how many of you like invest? If you look at it like 2006, 2007, the number was going up. I think it was about 65%. And then 2008, 2009, boom, it dropped by a large percent from about 65 to about 50. And the reason you see that is that people take all their money out. But if you imagine if you're a fund and you're at the top of the market cycle and people are putting more and more and more and more money in, and then when you get to the bottom, people are taking more and more money out, you're left with loads of cash to invest when the market is really expensive. And you haven't got much cash to invest when the market is down. Not only do you not have much cash to invest, you're often forced to sell big parts of your portfolio when they're undervalued, just because everyone's trying to pull their money out of the fund at the same time. And that is a huge, huge problem. It's one of the biggest reasons why so many funds just don't manage to beat the index. It's not that they've not got the expertise to try and tell where the market is changing and where the cycle is changing. It's just that they're under massive constraints from investors. Back end mutual funds. Some mutual funds are set up back end where it's not particularly great. Like the massive fee comes when you cash out. It's a massive exit fee basically, and I don't really like that. But I see what mutual funds are trying to do. But trying to get out of the problem of all these investors trying to sell at the same time, causing a run on the mutual fund. They don't have enough cash reserves to give the investors their investment back, and hence they're having to sell shares, which they would otherwise, think they're undervalued and want to buy more of. In terms of, just one more point on that. In terms of, a lot of successful investors have said the number one thing is being contrarian. like Benjamin Graham, what's the quote? An investor is someone who sells to optimists and buys from pessimists. It's something along those lines. I'm paraphrasing it, but it's something like that. Warren Buffett, be fearful when others are greedy and greedy when others are fearful. A lot of the time, mutual funds can't afford to do this because even if they have that mentality themselves, their clients don't have that mentality, and so they're not able to beat the market in that way. In terms of management, that's not quite as bad, but there's a lot of diversity constraints. And what I mean by that is that, they have to meet targets like 40 different stocks across loads and loads of different industries. And when you have that much diversity, it always comes out as like diversification. Like, first of all, you've got so many stocks to manage. And second, like, if the stocks are so diverse and so representative of the general market, how are you going to beat the general market by such a general way? Like, you could have 40 stocks and, like, sure, they might be an okay 40 stocks and you might beat the index by 1 or 2%, but that's different from having, say, 10 stocks that you have really, really high conviction for, really well researched. You have 4 times the amount of time to research it. And those are your 10 best stocks. So it's going to do much, much better. But unfortunately, because they have certain diversity constraints to hit, industry diversification, sector diversification, country diversification, a lot of the times the analysts of the funds, they can't make the decisions that they want to. In fact, we had this here, like the fund, in the FT. In fact, literally this morning, I read the funds are on course for like the worst ever annual outflows, when the market has actually had a very good year. Most of these investors were kind of withdrawing in March when these kind of all-weather portfolios weren't as good at protecting against downside as investors otherwise thought. Like, who knows? COVID's a black swan event. But basically what happened is a lot of investors pulled out. But since then, we've seen the market, do really, really well since it bottomed out in March. And this is just an absolute classic of why these funds can't outperform the market. Right. This is quite a big slide. Any questions, David? No.
Again, not yet, but if anyone's got any questions in the meantime, feel free to type them, turn your mic on and ask them. You can put your hand up on there's a hand up button if you go on right now, and we can come to it. I'm just checking 1 second, Henry.
Yeah, no problem, man. I'll give it 5 seconds. Again, feel free to ask anytime. You can always interrupt me.
Yeah, no, nothing. So go ahead, and then I guess if we get one in the chat, then we can go to it.
Right, this is another one of my favorites. Much lower liquidity constraints. So the absolute beauty of it is that, you might be thinking, what's the point of going to invest in Apple or Amazon or Disney or Walmart or AT&T when they're covered by 50 analysts? Like, are we ever going to find those opportunities undervalued? The answer is yes, you do. But for other reasons, smaller companies often deviate much further from where the share price should be, at least on a fundamental quantitative point of view. You can also see much more kind of volatility and many more like psychological advantages in the technicals. But again, that's a topic for another day. Okay, so in terms of liquidity constraints, let me explain why this is good. What I mean by liquidity is that, like, in order to buy and sell shares, there has to be someone else willing to sell you those shares. Like, every time you buy a share, it's not just like it's been newly issued, right? Shares get newly issued, but in the short run, what's happening is that it's a buyer, it's a seller. There's someone else that wants to sell you shares, and you buy the shares, and you just get connected by a broker on the internet. If an institutional investor has a lot of money, they won't be able to get much money into that investment. I can imagine what is on the slide is probably distracting a lot of people. So I'll go through that now, and then we can have a chat about it. Right. So imagine you've got this company. Henry Cycles is publicly traded. It's got a market cap of 60 million. So let's say the share price is £6 a share, and it's got 10 million shares. Its normal market size, which is effectively a measure of how much liquidity you can guarantee to buy the shares, it is 10,000 shares. You could get 10,000 shares relatively liquid like that, boom. Which is a measure of how many shares can definitely be traded at the current market price of $6 a share. So let's say BlackRock comes in and they think Henry Cycles is a great investment opportunity and they want to buy in at £6. Since the normal market size is $10,000 or 10,000 shares for £60,000, the maximum stake that BlackRock can definitely take at £6 a share. The maximum is 60 grand. If they wanted to buy more, which they would, they might have to purchase the shares at a higher bid price, which might involve them just passing up on the opportunity altogether. They might not want to do that. The problem is that these institutional investors, they control so much money. Small cap shares, the liquidity is just not worth it for them. So like, for example, the thing that I used in this presentation was, say, for example, their fund is worth 6 billion and they want to put this investment in. It's pointless to even spend their time looking at these investments, since if they did, they would be constrained by the liquidity. If they went to go and buy the shares, that would only be 0.001% of the fund's portfolio, i.e. 60K over 6 billion, because that's the amount they can liquidly get in. It just wouldn't be worth the time or the effort to like research them, where like, even if we go in, it's only going to be like 1/100,000th of our portfolio. Why would you? Say for example, David Dweck came in and he's a small individual investor and he saw an investment opportunity in Henry's bikes and his portfolio was 50K. He could allocate 10% of his total capital, 5K, like that immediately. And he wouldn't have to worry about going anywhere near the liquidity constraint of 60K. So that's what I'm talking about. This happens all the time. This is why you'll see like, brokerage firms heavily cover companies in the S&P 500 because all the big institutions can invest in them. I was on a podcast recently where like Warren Buffett was trying to get exposure in gold, and the shares he bought were in Barrick Gold Corporation, which is like the largest gold company. It's not the gold company that I hold, and I don't think, looking at the metrics, it would be the company that Warren Buffett would ideally like to hold for gold. But the reason I think Buffett chose Barrick and not something else is these liquidity constraints. Barrick had the largest market cap, and it was one where he was able to get an exposure in gold that was sufficient in size, for him to actually make up a significant part of his portfolio that would lodge him a decent gain if he were to invest. Have we got any questions, David? Anything you want to add?
We don't have any questions, but I will add to that this is such an important point. When I was doing an equity research internship last summer, I put forward a company to the portfolio managers, which was a really, really good one fundamentally, called Cape Technologies. It's like a cybersecurity technology company, and it's traded on the London Stock Exchange, right? But they wouldn't buy into it. They agreed with my thesis that it looked like a great investment, but the volume of shares that were traded was so low that it wasn't worth it for them. It was too high a risk because they were constrained by liquidity. So I was like, well, I'll go invest in it myself then. So I think it's a really good point that you've raised here for sure.
Do you remember what the market cap on Cape was?
The market cap was, I was just looking at it before, it was 383 million.
There you go. I mean, yeah, that's not a small market cap, really. From an institutional investor's point of view, sure. But like, it's not like all the investors for 383 million are trading penny stocks. It really isn't. Yeah, again, to use an anecdotal example, I'm invested in a company that, their market cap at the moment is about 450 million. And I remember when before the broker, the actual the sell side were taking notes on the annual reports and asking questions. Nobody was investing in them. There was no brokerage coverage at all. Great quarterly results, like share price went up 40%. People started trading a bit more and taking notice, and then the sell side analysts get involved, and then the ball starts rolling, more research comes out, and then more buy side people take a look at it because the sell side are doing research, and it's just a snowball. And this is how like these companies snowball to fair value. But I guess who owns these companies when it's just like the market caps are like 200 million or less? Like, it's people like us, because you can't do it. Like, you just can't do it. Like, if you can't just like come in with 20 million, just go boom, I want these shares. You won't get under. But if you're going in with an investment like 5K in one of these companies, like you can easily go under. But yeah, you won't be able to trade it because, as David said, the volume is just not sufficient. Yeah, that's the point on that. Okay, number 4, advantages for the individual. Right, many traditional advantages have been eroded. Okay, so I talked about like technology and shit back in the first kind of slide and said, look, they have all these technological advantages. Basically, that was much more true like 20 years ago, 30 years ago than it ever is today. Yeah, so a lot of these advantages have been eroded. The internet is basically democratized everything. Like the information is so fluid. Like, you know, it's very difficult for analysts to kind of get ahead and react to that. And also trading online is incredibly convenient. Like if you were trading in the past or like investing in the past, like imagine if it was like the 1970s and you had to like phone up your broker and you had to get like a copy of the FT just to like get like the price to earnings ratios and the dividend yields of like the FTSE 100 companies. Like say, for example, you couldn't get a PE of a FTSE 250 company or like the annual reports, right? Like how would you just, like I can just get an annual report, the click of a button, go Control F. I want to look at corporate debt, type corporate debt in. Within 2 seconds, I find all that information for myself. I don't have to worry of any third parties, anyone trying to sell me something. It's boom, it's there in the company report. Yeah, so before the internet, stockbrokers, they had much more influence over your trading. So a lot more power was with the institutions. Unfortunately, the incentive structure of stockbrokers is also mixed up. If anyone's watched The Wolf of Wall Street, again, I'll paraphrase a quote, but I remember Mac Hanna was sitting with Jordan Belfort at the start of the movie, and he was like, we don't care if the stock goes upwards, downwards, sideways, it's a load of fairy dust. He said something along those lines. And what he meant by that was that like these institutions, the stockbrokers, you know, they don't make the money by helping their clients generate money. You know, some of them are good and they do. People like Jordan Belfort and Stratton Oakmont, they don't. All they care about is the fees. That's how they make money. They make money off brokerage commission. All they're doing is they're encouraging you to trade. And that's what Jordan Belfort did when he set up Stratton Oakmont in the kind of early 90s, I think. You know, the way that would work is that he would lure people in with blue chip stocks with low commission, you know, stocks that they can trust. Again, you know, this kind of stocks in the Dow Jones, and then he would try and sell them penny stocks where the commission rate was 50%, and he wouldn't care if these stocks went up or down. He would make the 50%, and that was it. But yeah, like luckily this isn't so much a problem anymore because information has been democratized, and it's harder for brokerage firms to pressure you to trade because the information is there for ourselves. Anything to add, David?
Yeah, again, just a great point. Like you think about it, you break it down onto a student level for us. You know, we can go to the library, access the Bloomberg terminal, which would have been unthinkable 10, 15 years ago. You know, with I'm literally on trading 212 now, just to prove a point. You know, with a touch of a finger, like I can be managing my own portfolio. I don't have to phone up a broker. It is so much easier nowadays for us to be able to do that than it ever was. And I think, yeah, it is a really, really interesting point for sure.
Absolutely. And it's another point why like I really just like advocate investing in trading, because it's much less like stressful or much less difficult to kind of do it than it was a few years ago. This is a great side hustle for people to get into if you find it interests you, you have the right kind of you know, if your brain works well with kind of finance and numbers and shit. It's a really, really good thing to get into, just because it's so easy these days. It's not, you know, we have so many opportunities that people like 30 years ago didn't have, purely because, or primarily because of the internet, let's say. Okay, so the median fees for investment funds, yeah, the fees are quite expensive. I mean, they're better than they used to be, again, because of the democratization of information, but it's still something to consider. So this chart, because it's got 2 bars for every kind of type of fund. The mutual funds are for retail investors like myself. They're the funds that I can go and invest in. The institutional funds, you know, they're for kind of the large investors who also need funds. Yeah, so like pension funds, they will go and invest in other funds. exclusively for the institutions. As you can see, the median fee is around 1%, with emerging markets funds charging the highest fees. The reason why, at least as far as I'm aware, the fees are lower for the institutions is because the institutions provide them with more money. So that, that creates a competitive environment where, the competition of the funds trying to attract the institutions and the institutions going to the funds, they don't require so much of a return to keep the fund profitable. They don't require so much of a fee to keep the fund profitable because they're giving much larger sums of money. like 0.5% of a billion is a lot more than 1% of 100,000 is what I'm trying to say. 1%, let's not underestimate this fee. Most of these, what is this? Yeah, the other point is that I go back to diversification. Like at the same time, most of these funds are so diversified, their investments are actually very representative of the stock market index. So what does that mean? If you've got a fund that's very representative of the stock market index, and then you take off a fee of 1%, many actually fail to beat the index at all. And we can see a graph here, and it's rising as well. You can see the percentage of funds. In fact, no, excuse me, it's not rising. The year, that's not in chronological order. It's just in order of percentage of years they didn't beat the index. But as you can see, it's consistently around 50%. And you look at these funds. Hey, Amrit, how you doing? You look at these funds.
Hey guys.
Hey mate. You look at these funds and you think, shit, like the median on that or the percentage on that's a lot above 50%. If we just hang on, if I just move you guys, we take the median. I reckon the median's about 60%. So as you can see, the funds make up the general market. When you take off the fee of 1%, well, there you go. It's the majority of funds don't even beat the index. So you're paying for something that is not particularly great return. So that would be the kind of the final disadvantage, the institutions have over the individuals is that these fees occur. Right. So we've talked a lot about these mutual funds, and after everything that I've said about the do-it-yourself way and how they can provide people a lot of benefit, mutual funds, they might be a good opportunity for you. You've not got much time on your hands. If you know what you're looking for in a mutual fund, you find one that's good. There's still an option to consider. So it's a good point kind of going over them. I'll also go through other alternatives later on. Right. So investors, the way it works, investors pull their money together to a fund manager. They choose the securities, the professionals, that generates a return. And then that return is passed back to the investors. A fee is taken out. As I said, median is about 1%. Those are the basics of how it works. Okay, I will touch on this quickly because I'm aware we've not got that much time. But I wanted to talk to you about, at least give you guys a rough idea of how to select for a good fund. So the most important thing, hands down, is to look for something called a fact sheet. That will kind of give you all the information you need, or at least the basic. That's compiled from the fund manager. And it's basically the fund equivalent to an annual report, although it's very, very concise. They'll give a page on what we added, what we didn't add, what we did well, what we didn't do well, who this fund is appropriate for, sector breakdown, performance breakdown, country breakdown, that kind of stuff. And you can kind of gauge whether the fund is for you. The brokerage account may also provide a direct link. So if you look at a fund on a brokerage account, it might actually link you straight to the fact sheet as opposed to like going on the funds management's website, selecting by fund and then selecting by fact sheet. If the fact sheet is well presented, organized and informative, this is the first indication that a fund is a good consideration. If a fund can't put together a good fact sheet, very, very basic data, very basic writing and conveyance of information for you guys, then how would you expect them to make good research reports and make good investment decisions? It's the same thing, kind of like, if you were looking at a company for web design and their own web design was shit, or a video company, you know what I mean? It's you've got to kind of put your money where your mouth is with this stuff. So fact sheet, again, great initial indication. You should also look at some other things, which I'm going to go through now. Okay, so qualitatively, most of this stuff will be on the fact sheet. You've got to compare your risk tolerance to the fund's risk tolerance. As I said, this goes back to a lot of what we talked about in session 1, where you have the Jamies and the Etfs, and Jamie's a young working professional looking to grow capital quickly. Ethel is looking for kind of stable income. So you want to compare, is the fund's goals aligned with yours? As I mentioned, a lot of funds' goals are tied to what the rich people want, because the rich people is where they get the high commissions from. But you will find fees, you'll find funds are a little bit more geared to kind of the high growth accumulation that smaller investors want as well. Deep dive on management. This is very, very important. It's like researching, again, the management of a company and the CEO and all that. You want to look at the track record of the fund. You want to look at where they worked at before, where they were educated, maybe how they got into this stuff, their motivations. Diving in on their social media is very important as well. How do they present themselves online, on social media, on LinkedIn? That's always important. When the spotlight is turned off them, what kind of person are they really? One of my favorites is to go on YouTube, try and watch some interviews of these funds, get a feel for the kind of person they are, get a feel for how they think. Are they the kind of person that you would want managing your money? Because whilst they have a lot of analysts under their belt, it's the portfolio manager that kind of calls in the shots. The way they do it is they have kind of a weekly meeting with all the analysts from all the different sectors, and it's boom, it's the portfolio manager that calls the shots. So I kind of touched on this already, but make sure the investment philosophy aligns. If you are understand value investing and it resonates with you, a fund that promotes that as well is great. If you're looking for income, a high yield fund is great. If you like your dividends, if you're into your ethics and you want a fund that invests ethically and responsibly, and takes into account companies that treat their employees fairly and that are managed well, then an ESG fund is good. If you're looking for growth accumulation, if you're kind of young and not much to lose, then check that. The same goes with the sector and the country breakdown. If you know a lot about China and the emerging markets, you have a strong conviction on them, go for an emerging markets fund. It's important to, you don't have to understand every individual investment decision, but it's important to understand the gist of the fund's investment strategy and their investment objectives. Understand the benchmark of the fund. That is basically what the fund used to kind of compare if their investment return is good or not. So for example, say it was a UK fund investing in large cap companies with a focus on getting companies that produce good dividends. So it's an income fund. Then they would compare the kind of income stocks in the FTSE 100. They'd probably use the FTSE 100 or a high yield FTSE 100 as a kind of benchmark. Quantitative factors. Okay, so again, a lot of this might go through people's heads, but watch it back, Google these terms for yourself. In terms of where to find a lot of this information, I haven't invested in a fund in a while, but I usually go on Fidelity's website. They usually give quite a good breakdown of all of these stats. If you're looking for a free data source, you don't even have to have an account. Just Google a fund on Fidelity and they'll kind of tell you all of these. So the expense ratio, again, that's pretty much the fee that you're paying. It's finding what it's costing you in a year, percentage-wise, to manage your money. I would say, well, as we looked in the data earlier, median's about 1%. Anything under 1% tends to be pretty good. If it's really, really low, you also have to question why. If it's like a 0.1% fee, you also have to question why. If it's good reason for that, sure. If it's a fund where they're taking like 2% fees, just nah. It's not worth it unless they can demonstrate a really, really, really consistent, good investment strategy and needs to have higher fees than the general market. Then it's not worth it. Right, the turnover ratio. This is an interesting one. This is like the percentage of the fund that's bought and sold in like a given year. It tends to not be a good thing if you have a high turnover ratio, just because people tend to invest in these funds for the long term. They tend to be fundamental based funds. If the manager is constantly buying and selling, it might show they don't have like a strong conviction for their investments. It also, high taxes, right? Like even if you're in an ISA, the fund managers, they still have to pay tax on their investments, and that is eating into your investment indirectly. It could be all right if it was a very technical fund and it specified short-term time horizons in the fact sheet. But if not, I would generally look for a low turnover ratio if you're investing for the long term. Alpha is a measure of the fund's performance against the benchmark. So for example, if an alpha was 1, it would have beaten the benchmark by 1%. So it's a very useful thing to see, right, is this fund beating the benchmark considering where it's supposed to be. Is it doing better than it's expected to be? Is a way to measure to alpha. Beta is a measure of the volatility of the fund. A beta of less than 1 would mean it was less volatile than the market. More than 1, more volatile than the market. Beta of 0, no correlation. Beta of negative actually moves in the opposite direction to the market, which wouldn't be good. If you had a short-term beta that was negative and we're in a huge crash, then sure. But in the long run, you typically want a beta probably between 0.7 and 1. But it depends on what you're looking for. If you're looking for a tech fund, you're probably going to see betas of 1.3 plus, and that's fine because these stocks tend to be more volatile, and that's what you're going for. Information ratio, similar to the Sharpe ratio, if people have heard of that. I don't have the equation for the Sharpe. I have the equation for the information. The Sharpe ratio is basically this, but you've got the risk-free rate here. This basically allows the funds to be standardized for its benchmark. So you can kind of see, it basically measures how the fund is doing in terms of how much of that excess return was made compared to the excess risk. Because like a fund might make more return, right? But if it's all down to extra risk, then it's not exactly down to the fund's own merit. It's just because things have happened to go up like they have in the general market. So that's where the Sharpe ratio can come in handy. And standard deviation, again, that's a basic statistical term, but that measures just variability in annual returns. So it kind of measures how consistent the fund performance is. Right, I appreciate that was a whale of information. David Amrit, if you have anything to add, go ahead, and then we can do some questions.
On my part, no. I'm amazed that you managed to get through all that and so convincingly. I think the one thing I find when I'm looking at fact sheets for funds is often they can be great. They're concise. It's so much easier to read a 1 page of A4 than like 385 pages of an annual report of a singular company. But sometimes I think they lack a lot of detail, make it very, very hard to analyze a fund. But I know that a lot of funds then tend to have prospectuses which go into more detail, but that is definitely in my mind like an issue as an individual investor is trying to look at a fund and actually working out if it's a good investment because there isn't so much detail. You have a fact sheet, you have prospectus, and apart from that, like
I agree. And the reason I said Fidelity with these quantitative things, like Fidelity is like a big asset manager. They're not. When I say that, it's like a fund Wikipedia. It's quite sad. You won't find most of these ratios on an actual fact sheet. So David's right in that regard. Yeah. Go ahead, Amrit.
So I've only just got one point, which is you just got to be really careful when you're looking at funds and you're looking at like two different funds that sound very similar. So you could look at like a fund which sounds, which is called like, I don't know, US industrial, US large cap industrials. And then you could also look at, I don't know, like large cap industrials, North America. And you could say, oh, okay, they're kind of similar. And if you don't look at the fact sheet or if you don't look actually in depth, you might actually find funds that are just creatively named just to kind of attract that attention. And just kind of stemming from kind of the ESG trend that we discussed kind of last week and in the weeks before, you kind of get a lot of funds that actually rename themselves kind of sustainability index or sustainable companies or ethical companies, something like that, just to attract money. Because, these funds, they make money with more people that invest in them. So you just got to be careful and actually do your homework. Yeah, that's just one point.
Good point. Yeah.
100%. I know.
Go on, David.
I was just going to say, even with Fidelity, I know they've got for example, they've got one called Special Situations Fund, but I think they've got 3 or 4 different special situations types of funds. So yeah, you're completely right, Amrit. There's a lot of crossover, a lot of very small name changes that you've got to be wary of.
And at least from my experience, most people, they don't even go into this much detail at all when they invest in a fund. And I think that's a bit of a shame, really, because like I get like do-it-yourself investing and like building discounted cash flow models and trying to build complicated investment thesis is very, very tough. But like, you know, if you're looking for somewhere, if you've got a decent amount of money, like I'm saying like 5K plus, right, of long-term savings, you know, it's not that much effort to understand a few of these terms. Pick a fund, particularly if you're holding onto it for a few years. You know, you could do that in one afternoon. But it's just kind of ironic that like a lot of people that I know, they will just like get like a funds tip from a friend. It's like boom, like all the money goes in there. And just within a few hours work, you could really like separate the wheat from the chaff in terms of good funds and bad funds.
Yeah.
There's also kind of a danger that if you don't actually do your homework and you don't look at the funds in depth, you'll miss out on the trend that you think you want to follow. So if you want to follow kind of like Asian Asian focused kind of stocks, you might actually be able to if you pick a wrong fund that just sounds kind of quite right, you might actually be picking large international companies with a focus on Asia instead of actually homegrown Asian stocks, and that's just going to impact your returns. So do your homework basically.
Yeah, it's interesting. A lot of the capital inflows again into these funds are directly done by institutions. So most people that have got a lot of money, they'll go through wealth management, and then all the wealth management will do is they'll just sit down and say, how many dependents have you got? Have you married? What are your assets? What are your liabilities? How long are you projected to live? How much money do you need? Like what's your salary? When are you expected to retire? And then what happens is the wealth manager goes and selects them for them, which is fine. Again, then you're getting hit with fees twice. The wealth manager has to pay fees to the asset managers, and then you have to pay fees to the wealth manager. And again, it's just a very quick side point because I'm aware it's nearly 7:30, but sometimes there's a correlation between the most exclusive looking funds and the highest fees. I don't want to mention any names on a public call, but you will see the kind of wealth managers, a lot of wealth managers, they kind of play up, it's grandiose. You get put with some very clever talking people in some nice room. And unfortunately, they prey on rich people that aren't financially smart. Like maybe they've inherited a lot of money or like family business or whatever it happens to be. And unfortunately, they tend to be the ones with the highest fees. Again, I don't want to mention any names, but I've seen some ridiculous fees, and people don't understand the base. And even like where annual returns, they're not spelling it out correctly, and the rich people just go, oh, etc., etc., etc. Again, not a lot of investors are like that, not a lot of rich investors are like that, not that many wealth managers are like that, but I have seen it happen. Okay, very quickly, I've got 2 more slides, David. Advantages versus disadvantages of fund investing. So we've pretty much been through this. Like if you select a well-performing fund, good on you. You can beat the market by a significant percentage, and it is much less effort than doing what I do and managing your own shares yourself. So it doesn't take a lot of effort to manage once you've invested. I touched on that in the last slide. Like you could find a really good fund that leads all your investment needs. You've analyzed it quantitatively and qualitatively in one afternoon. All you have to do then is spend like half an hour following it every month to kind of see where the management kind of is at, see what is added to the portfolio, and check it still aligns with your philosophy. That's all it is. It's not a difficult, time-consuming thing to do. And I wish people pay more attention when it's like their life savings going to funds. Like it's not that much effort to find one that's good. They're only traded once a day as well. Like this is quite interesting. Like if you're somebody who really, really gets bothered by the fluctuations in stock prices all the time, like every minute, it eliminates that like impulsive buying and selling. It also eliminates investors from kind of doing arbitrage, like very short-term traders, but literally they're listed once a day and boom, that's it. Disadvantages. Yeah, so if your fund doesn't perform well, you're going to be paying high fees on top of an investment that's not beating the market benchmark, and hence you end up with a subpar return. As you saw from the evidence back then, that's the case with about 60% of funds in the long run. And what was the year where it was like 80%? What was the year? Let's have a look. 2014. Yeah, 87% didn't beat it.
Wow.
After your fees got taken off. You've had a few years that have been like that. So this was in 2018. It's not been great recently. I know this isn't in chronological order, but you can see the general trend is as we move later through the years, there's more and more that aren't beating the index, which is quite interesting given that fees have gone down. Right, back to this. Yeah, so yeah, again, another reason, all the reasons highlighted in the first part of the presentation that comes from not beating the index, the constraints from customers, the constraints from management, the liquidity constraints of not being able to invest in small caps. By the way, there's a lot of evidence to suggest that small caps outperform large caps, particularly in January. When everyone is asleep between Christmas and New Year, remember that. Not investment advice, but the small caps will outperform in January. The incentive structure is often messed up as well. As I said, like they're here to tailor for high net worth clients and want wealth preservation and stability. They're not geared for people like us who are young and we want rapid wealth accumulation. Again, this is another one. Most funds do have minimum investment requirements, again, because it's not worth it otherwise. Some of them are quite small, actually. Like most are about a K from what I've seen. But you know, if you're trading pennies and fractional shares on trading 212, you might not have enough money to get into a fund, and you might want to consider something else. Okay, very quickly, because we've slightly overrun, I am going to go through ETFs. So yeah, I mentioned an alternative to funds earlier. ETFs are effectively the passive side of funds. They're the main type of exchange traded product in the market, and they passively track the investment performance of a basket of shares by purchasing underlying investments. So unlike funds, these investments, they're not being actively managed or as actively managed. So like, it's not just like, oh, we hated McDonald's Q3 report, we're going to boom sell now. It's not quite like that. There will be some form of management, but it'll be more passive. It'll be something that's often done by a computer. And because of that, they have much lower fees, which is an advantage. Yeah, so there are many types of ETFs. You can get ones that track indexes. You can get ones that track industries. So for example, like if you wanted exposure to the renewable energy industry, you did not want to pay the fees of a fund. You did not want to take the risk of only, you know, holding a couple of renewable energy stocks. You can use a renewable energy ETF. That's one example. Commodity ETFs, they track prices of gold and oil, et cetera, like, you know, it's hard to get exposure to physical gold or physical oil. It's very impractical to store. Investing in a company, in a gold company, a commodity company, is effectively a leveraged position on commodities because they have high operational gearing, high amounts of fixed costs, which makes them very sensitive to changes in prices of these commodities. So buying an ETF is a good way to be indirectly invested in the commodity. Currency ETFs, they track currency movements. And bond ETFs, I know nothing about bond ETFs, but they effectively track different types of government bonds. I mean, why would I when the interest rates are so low? But yeah, price. Okay, so the price of the ETF, this is important. Like, it's not so much influenced by buying pressure, selling pressure. The price is determined by like the underlying assets that the ETF tracks. Effectively, it's not so much like shares where if you're getting loads and loads of buying pressure and loads of demand for the shares, that is pushing the share price up because sellers want to sell at a higher price, or they're able to sell at a higher price. It's much more the price of the ETF is like the money is flowing from the capital account to the investor, and in that capital account is the actual basket of securities or bonds or whatever happens to be that tracks that investment performance. ETPs, I know a lot of people have been using that term recently. They're largely similar, but ETFs are like the main type of ETP. ETP, like they allow you to employ leverage and short selling. And the thing about ETF, I wish someone could clarify this for me, but I don't think they're always tracked. They're always backed up by the actual underlying asset. Sometimes they are, but they're not always backed up by the asset. And that can be quite dangerous, right? Like if you had gold prices surge and the ETP wasn't fully backed by gold prices, right? And the market cap of the ETP was changing, and the gold price was going up, and all the investors were like, sell the gold. Like, what if the ETP doesn't have sufficient funds to reward all the gold investors? It's easy enough for the ETF because they can just sell the gold in the market because it's fully backed. But the ETP might not be able to do that. I don't know much about the ETPs, and if you guys want to shed some light, please go ahead. But yeah, that's pretty much everything. David, Amrit, if you have anything to add to the last slide, go ahead. And if not, we can take some questions.
I'm conscious of time because we're almost 10 minutes over. So I'm not going to add anything right now. If we've got any questions, please put them in the chat or turn on your mic. Amrit, have you got anything? If you don't, I will just wrap up.
No,
but
no.
Okay, fine. Right. Well, firstly, Henry, thanks so much again. You've been doing this now. What is it? Session 5, I think. 5,
Yeah.
6. Every week, it's unbelievable how much you get through in an hour or an hour and 8 minutes. The detail, the slides, everything. I know it's a lot of hard work for you, so I really appreciate it. And if you all have enjoyed the session, please let us know. If you haven't, also let us know. It'd be great to hear your feedback. A quick thing. I know 1 or 2 of you in the chat aren't official members of our society, but do go to UOB. So if you've not signed up, there is the link to sign up. It will take 1 minute. It is free. Voting closes for Bright Network Society of the Year awards very, very shortly. I think it's Friday, and we want to win. We've been shortlisted for the Impact on Campus Award. So go vote using that link. And the final link is for our event on Thursday night at 7 p.m. We're doing a collaboration with EconSoc and with Women in Finance Society. And it's an event with a former director of Goldman Sachs who's going to be talking about markets, his career, doing a bit of a Q&A with you guys. It's going to be incredible. So if you've not already, go sign up using that link. Sorry for all the links. And I guess the last piece of news is we're going to be putting out a reading list, hopefully later on this week for all of you. So you got some stuff that you can read over Christmas that we recommend, get your knowledge kind of improved. And I'm trying to think if there's anything else. Yeah, we're going to have loads over Christmas. We're going to put out a couple of investing one-on-one sessions for you. We're going to set up a virtual fund that you can all take part in. And I guess that kind of relates to the session today, actually, about funds. And yeah, thank you all for your support this term. I hope you've enjoyed. Please definitely let us know if you have any suggestions, recommendations, anything that we can do differently, anything you enjoyed. And if not, have an amazing Christmas. And thank you, Henry, again.
Cool. It's okay, guys.
So I know that was a lot of rambling, but and a lot of links. But yeah, thank you for coming. Enjoy your evening, enjoy your week, and see you on Thursday for our Goldman Sachs Director event with Chris Clark. All right, I'm going to turn off record.